Welcome to the show, everybody. Let me know that you can definitely hear me and everything in the chat. It's good to be here. My name's Rocky Outcrop. And this is the weekly financial show. We're going to be talking about big stuff in today's show. So big, in fact, that I didn't know if I would even actually go ahead and make the show. I thought, this is too big for the markets to know about. I don't want to be the one that's bringing this to everybody's attention and to be blamed by the entire market for what I'm saying. But that's the level of today's show. We've been talking about the macro and the micro. I've got it all laid out for us. Big plan, and we're going to complete it in less than 45 minutes with audience contributions to the chat. And there's a goal running right now. You can vote for whatever you'd like to have technical analysis done on. Micro is technical analysis, and like macro is talking about the big picture in a sense here in the show. There's big stuff happening in the world right now. You can see here beside me, just there, that Bitcoin is currently going through rough times, having a big dump. Here's the SPX chart, and lo and behold, it's having tough times, a big dump as well. But the day didn't start like that. The day actually had a move up at the start of the day. Just open up something like a futures chart here so you can get a kind of maybe clearer picture of what went on. And you can see here, throughout the session coming into the day opening up, we had prices moving up. Of course, when the actual regular trading session started, prices dropped down. What was giving the market some buoyancy running into today's open? And that is, of course, one of the Fed governors talking about the potential for more cuts, because interest rate cuts would make the markets happy. And that then has kind of been forgotten about, and we've gone back to thinking about the major news story of the week so far, which is, of course, the Bank of Japan. Why is it the major news story resurfacing when it came out on Monday as the news? Well, it's to do with the fact that the actual rate hike would be happening on Friday. So it's this should be fixed. Right. It's working now, right? Make sure it's working now. Okay, so first 5 minutes of the show, the buffering was happening. It's a quick intro to what we're doing today. It's really big stuff, really big news, and I don't know if anybody in the world is really aware of it right now. They're kind of delaying on it, and it's a story that needs to be explained. I'm going to do that and achieve it within the next half an hour. It's going to be big stuff, and you'll learn an awful lot about an ecosystem, and by knowing that ecosystem, you'll understand something else. I'll explain what that is at the end of the show and what the key insights you've been able to take away from what we synthesize from everything that's happening. As US unemployment hits 4-year high, jobs reports showing that. And there's a double-edged sword here, or two sides to this story, rather, I should say, because on the one hand, it shows weakness in the economy. It's that's negative, and people have been trained to think that stocks will go down. Like we look at the 1900s and see the big crash and say that's what happens during recessions, 2001 or 2007, and you say, look, that's what happens during recessions, everything crashes down. And that's a big part of today's story too. I'm going to explain it all to you, and you're going to get amazing takeaways. It's going to be really useful for you. Incredible stuff. It's just amazing insights coming up today. So it starts off here by looking at this and saying, well, two sides of this. One of them is, of course, that reduced jobs, people in employment, higher unemployment data is a signal to employment. The other one is to address inflation. So it takes the eyes slightly off inflation and increases chances of a cut. That's great. US CPI data is coming out on Friday, which may also give us more insight and put the eyes back on inflation in a wee bit. And but there also is the negative side to this, which shows a weaker economy, and that is being compounded by this other news, major news of the week, that Bank of Japan is going to take interest rates to a 30-year high, which is a relative increase of 50% up from where they were, which is better than going up 100%. It's a small incremental increase of 0.25%, which is good, for them in some ways. Increases the strength of their yen, perhaps, and that is good at dealing in tariff conditions, trading with America and so on, but they're a big export-heavy economy. It doesn't want a strong yen necessarily, but it does want to change the regime from 30 years of negative stuff into a positive inflationary regime, because that's actually positive. And the Fed's target is 2%. Japan is actually happy and able to celebrate. If it gets anywhere near 3%, it's actually celebrating that, which is why it feels happy about raising the rates and stuff, and it's actually a positive story within Japan. But it's not a positive story for markets, and as we can see here today, the markets have dumped, which is in the face of a rise up this morning that happened, which was because of the some chat, a Q&A that happened from one of the governors of the bank, of the Fed, and the Federal Reserve, talking about how, you know, the chances of a cut have increased. People want a cut to happen because it'll help the economy in a lot of ways. However, again, like I said, people are associating the economy and recessions with stock prices, because if I go up to something like the monthly chart here on this, and we look back at times, you can see that there was this recession here in dot-com boom, and it followed by a long downward trend in equities. The 2007 financial crash, you know, even worse, all the way down there, and various other times when we've had sort of recession-y things, how that could happen. But there's been a different story over the last 4 years, and it plays a big part into what we're going to be talking about today. And another big part of what we talk about is, of course, because of this jobs data, it's to do with a really important economic indicator, which is called the SAM rule here. And it says here, when the 3-month moving average of the national employment rate is 0.5 percentage points more or above its low over the period prior 12 months, we are in the early months of a recession. And in fact, people have looked at this and say that it's, you know, works very, very well. We can see here the SAM rule is a robust tool that has been very accurate in identifying a downturn in the business cycle and almost always doesn't trigger outside of a recession. And this is partly because the calculation simplicity contributes to reliability. Also, it's to do with the way that recessions are, you know, denoted in America. The rules for them are different to the UK, for example. So these are this is a really incredible thing, and it's to do with, of course, job data. And there is a real-time SAM indicator that the US government publishes here. Fred, you've got publishing this data, and this can show you the differential, because you're looking for that 0.5 difference, as it says here in the rule, the 0.5 percentage point difference, and this tracks this for you. And one of the reasons why people then, of course, feel that there's this comparison with the Bank of Japan having this problem here is reminiscent of the problems that we're seeing in the economy back in the summer of 2024. It plays into this story in such a key way, is because of if we look actually 2024 to July, we can see that there was a reading of 0.53, but we don't see that this chart actually acknowledged that as having triggered it, even though it did every other time in its entire history, and every other time it led to one of these readings. Now, there's also something amazing happening right now with the SAM rule, which is really kind of concerning, that I'll be explaining in today's show. It's super important to understand, and it's all to do really when you tie it back to, of course, the one that happened back in 2020 and what's been going on in the economy over the last 4 years. And that brings us to the kind of overall look at, you know, what we'll be talking about today. As I said, one of the pieces of today's kind of story is, of course, UK Consumer Price Index, CPI data came out today, and this is one of the other reasons why the markets went up. You could look at UK Consumer Price data and the Q&A there as reasons for that. But there is, you know, so we saw, as I said, prices did move up on the S&P 500 and all kind of stocks this morning, and crypto and everything, before cascading in a big dump down. And what we have was one of the big pieces of news that a material surprise happened in the bank in the UK Consumer Price Index CPI core data for inflation. It came in at 3.2%, which is down from 3.6%, and that moved down in inflation month over month of 0.4%, like 10% down basically on what it was last time, is a material surprise and signals that maybe perhaps the Bank of England could do quicker or deeper cuts, which is great for the economy there and for interest rates now, of course, as well. The Christopher Walker QE, what was that about? And it's, you know, like he was somebody who'd voted for a 0.5% cut, 50 basis point cuts at the meeting, and now is looking at policy restructure for kind of more forward-looking plans, talking about 2027 and saying that there are room for cuts, being less restrictive. He's actually used the exact words to say that policy is now becoming restrictive, which is key kind of terminology. And that, of course, ties on the upcoming CPI data. The SAM rule not declared. We're going to be diving into RUT RSP, which is a big deal, and I'll not explain what that is just a second, and NVIDIA and Oracle. Why NVIDIA and Oracle? Well, NVIDIA and Oracle have had problems in their chart today. There's competition coming in from other people in the AI sector, such as Amazon, who've stricken a deal with OpenAI for what looks to be like $10 billion worth of hardware or something like that. So this sort of thing is impacting on their price. They haven't quite got like the go ahead to sell in China properly yet, and so on. Anyway, our technical analysis on this box in the past has proven it to be pretty darn accurate, and we can see that prices found support but then pushed a bit lower, and this move down, which happened today, has carried all the markets down. So we're still seeing that concentration really dragging markets down when there's only really one story to point to for a particular stock, and that's having a massive effect everywhere, able to overwrite the positive stuff that came in from the inflation data. And then it feeds back into the Bank of Japan story, which is what is dominating the news today. And it's why it's important to understand all of everything like this in a massive context. And then to ask the questions that need to be asked. The big one is that we need to start off with is this, the 4-year bull market, right? That needs to be exposed. And let's go back to the charts then and consider that there has been kind of a bull market in equities and crypto when you think about the last 4 years. But that needs to have a bit of examination. Why do people say that? Well, they say that because of things like the big indexes and the big stocks and the things which really largely are featuring inside people's like pensions and so on, but they're not saying it because of certain other things. So like, for instance, what you have is the reason why they're saying there's been a bull market. It's got nothing to do with the Russell 2000, everything to do with SPX. It's got nothing to do with altcoins, everything to do with Bitcoin. It's got nothing to do with debt, and it's got everything to do with savings, because companies that are geared and rely on financing have suffered, and those that have got savings have managed to ride it out and actually improve and do really well because they're getting, because they've got such cheap money from their big historical cheap rates that they got locked in on, whereas the middle belly, the Russell 2000, hasn't done that. And we need to expose this idea. And the other part of that, of course, as well, you're seeing is that the crypto markets had the same narrative about it, but it's not been true. And funnily enough as well, we've had a narrative where gold has been going up and up and up and up, but people haven't been saying that there's a recession, which is an interesting dynamic given that it's such a safe haven and equities have been rising at the same time. So you're seeing all-time highs happen on both the S&P 500 and gold at the same time, in a bit of an odd convergence flying in the face of what it is to be risk on or risk off, which all needs to be explained if you're going to understand how the markets are working. And that's why we are then going to look at these things in a bit more detail. And the way that we're going to start off with this exposing the bull market effort is by taking a look at RUT and RSP. So RUT here is the US Small Cap 2000 Index. And you can see if I go to, that's just been recent price action there. If I go to daily time frame here, we can see there has been a bit of an okay trend since back there in April, like there has been in the S&P, but still looking at that prior high, it's not really done much compared to it. That's the daily time frame. Go up to the monthly time frame, put this in a proper context. We can see the last 4 years. As I've said, yes, right now perhaps we're starting to ask a question about moving above the high in 2024 and the highs in 2021. 4 years ago, but for the last 4 years it's essentially been trapped inside the range of those highs. And even now at this point, versus the high in 2021, prices are currently, at the time of speaking, up 1.4% since 2021, which is not a 4-year bull market. To move 1.4% to the top side in 4 years is not a 4-year bull market. So let's thoroughly expose that right now, because let's make a quick comparison to other things like the SPX, for instance, versus the high in 2021, popping up to where it is currently. It's up 40%. You know, that's maybe divide that by 4, you get 10% a year, you're beating inflation and everything, and it's kind of on target for that. So it's a very, very different story. We can take a look over here at the equal weight S&P 500, which is called stock ticker RSP, and we can see here that even it is up, right? But let's make a comparison. Currently, today, it's up 1.96%. So there's an equal weighting. S&P 500 is up 1.96, and the Russell 2000 is up 1.4 over a 4-year period, whereas the S&P 500 in totality is up 40%. So in pension funds invested in indexes and so on have been well protected. The data that coming into the Fed about, you know, equities and so on has been very buoyant. However, the reality of the economy, including when you look at the S&P 500, if you exclude the really heavy weighting given towards the top performers, you find it's only up 1.96%. Where is the 4-year bull market trend? Let's take a look at another chart. Let's just call for others, which is a selection of the top 150 cryptos that doesn't include Bitcoin versus the highs it had 4 years ago. It is currently where? It's down 60% versus those highs, down 60%. That's not a bull market. That would be more like a bear market. And if we look over at something like total market cap, which does include Bitcoin, gives you that kind of synthesis of all of them, including Bitcoin. Well, we can see that the highs indeed pushed very, very high compared to the lows before, or the prior high in 2021. The high itself having achieved a move up of 45%. Actually, right now, during this feeling like a risk-off environment, the price of crypto total market overall is down 5% from where it was 4 years ago. So that's not much of a bull trend in terms of like where we are right now to where we were in the past. Right? I think that's probably right. Super interesting stuff, and I think that's very, very, very useful for everybody to know that super interesting stuff. Okay, so this is putting things into context, and this is what we had to do here. So I think we've exposed this, and we understand as well that a lot of this dynamic comes down to sort of debt versus savings. Now, one of the reasons why Bitcoin has gone up is, I think, worth noting, is to do with inflation, and it's not inflation in the terms of the cost of goods, it's to do with monetary supply. And when we're looking at inflation coming down, meaning cuts for interest rates would be happening, that being good for crypto. It doesn't mean because people will were previous, but it doesn't have to do with the fact that people were previously thinking, oh, the price of my gasoline's going up, so I'll buy some Bitcoin, and then in the future, if I buy it in Bitcoin, I've saved money versus that type of inflation. It's to do with the amount of money that exists in the economy. Over the last couple of years, the Fed has continued to do quantitative tightening, not quantitative easing, and it's not moved to quantitative easing regime. That's one of the things that we need to change, perhaps, for us to move out of this. But let's go then and visit the SAM rule, okay? Because let's just analyze this and see about how it works. We know the rules of the SAM rule. I read it out earlier on. 3 months of it's to do with moving 0.5% above the lows. But it's not just a one-off month. They smooth it out by looking at a 3-month moving average. So it's the 3-month moving average high versus the 3-month moving average low of the last 12 months. If your data now is showing you that it's moved 0.5% above that low, then the SAM rule has triggered. And we know that the reliability of the SAM rule triggering, as seen with these grey lines, is exceptional. When you look back to, you had the 2007 one being called or identified by it, whether it was a little bit late or a little bit early, identified by it anyway. 2001, again, had in the 1990s and the 80s. This is the original kind of Black Fridays and stuff like that. Super big deal. Back in the 70s, whenever you had the futures markets for commodities, inflation was so insane. And back in the early 70s and so on, with the move off of the gold standard, etc., all these different massive recessions that happened, all getting all of them. And every other time it didn't trigger in between. It got very close. You might be suspect here of about 2003 4.73, got as high as 4.7, didn't trigger again. Okay, in November 1992 it did trigger again, but it didn't get marked here as being part of it because this was having already triggered and not made it back down to the lows. Okay, so this didn't count, but here we did make it back down to the lows and then have a second stab at it, and it should have triggered it in 2024, but it didn't. And then there's the current time frame, and nobody's talking about this right now. So let's just do our own analysis of the numbers, and I've got them written out for us here. Okay, so if we take the unemployment figure and just write it out in a list as I've done here, you got the months of the year at the top, you've got 2024, 2025, and some moving average kind of numbers below. Then we notice that there's this big question mark, right, for 2025 October, and that is doing an awful lot of heavy lifting on this, and we'll explain this in just a second. It's incredible, but if you look, you can see that the lows, if you take January, February, March of 2025, those 3 months together, the average was 3.8. If we look at that was because January was 3.7, February 3.9, March 3.8, and the average is out to 3.8. So you would be comparing any time in this back to, for instance, over here, because that's the lowest period that there's been since if we do this whole thing looking back to December of 2024, then it's those months that give you the period of the lowest average. Let's call it 3.8, just in terms of that period, and then compare it to when we had the last consecutive 3 months of data to make the comparison with. And we don't have consecutive 3 months of data that are above 3.8, purely because by virtue of the fact that October's data was missing because of the government shutdown. So it's not been included in there. If we go back over to the SAM real-time website and I slowly go from left to right here, you can see it goes from September 2025 and then flicks over to, if you could see it, what you see there, if you could see on your screens, is that it misses the October. It's just not got a data point on the chart for that. Just not there. It's interesting. It doesn't exist because the government shut down, but everybody knows what the numbers would have been. They would have been somewhere around 4.3 to 4.6. If at any time those numbers had have existed, we would have triggered the SAM ruling already. Now, here's a curiosity for you as well. If we actually look back at the numbers from July, August, and September and make an average for this year, that comes in at 4.27. If we look back at 2024 numbers, we can see that July was 3.8, August was 3.8, September was 3.77. That makes 2024 3.77 on average. July, August to September this year, 4.27 on average. Amazingly, it's landed right on 0.5. It did it back in September. Nobody talked about it then. Nobody talked about it until October. They like to put in caveats. If we jump over to this page about how you use it, it's like, hey, you should, it's great, it works wonderful, but always like take it as part of alongside other economic data and indicators and so on. And because, you know, they had the excuse of not having other economic data and indicators, or like, let's not declare it. There's that as part of it, but also as well, what we're seeing is it gives a lot of optionality to the Fed. They could talk about it at any time, and that, but if they did talk about it, it would have economic consequence because they'd be saying, look, the economy's shafted. That's what saying the SAM rule has triggered means, because it's only happened ever at times when the economy's been shafted, only ever then. So for some reason they decided not to include it here in 2024 because of like other economic data, and sure, that made a lot of sense. If we go back over to the charts and look at SPX during that time, and you look at to 2024, go on the weekly time frame so you get a bit more memory of then. 2024, June, July, and August, you can see here that July through to August was like this 3 months of red candles, big push up, and that became the low, you know, of that entire period, and pushed on up from there. So like kind of at the time, with looking at the attitude in the world, you know, everybody was aligned with that one being okay, we got out of it. Right now though, the hysteria is high hysteria with regards to AI bubbles and so on, and it's got to be asked the question of, really, is that the case? Are we in that situation or not? So the problem here then, to identify it for us all, and thanks very much for being kind of tuning in, sticking with the show here, because it's pretty good, and I hope you're getting some detail and lessons from it. This is looking at the macro, and we're going to apply it to the micro, but so far I've not really done any technical analysis on any of these things. And but I am giving you some great insights on the macro picture, which you can apply to these micro technical analysis things. I've got a goal in the chat. We can do some technical analysis on something that's during the show here if we get the chance time-wise. But looking at this, you know, you want to be able to analyze this as well as I'm analyzing like the macro. Then you want to be getting involved in the school course. There's a code at the minute, save 500, and you will get a discount, a massive discount, biggest ever discount on the course. Head over to www.technicalanalysis.school and you'll be able to do technical analysis at a level that is incredible. No matter whether you're a beginner or a pro, it's a really great course. So let's identify the problem here. Problem is inflation, right? That's essentially the core of the problem in terms of why the Fed can't make cuts and can't talk like it's going to make cuts, and also it can't say this stuff about the SAM rule being triggered, even though essentially when we look back at this, we can see that there's been a silent trigger of this, and it's the second time there's been a silent trigger. But the difference, as I was trying to point out there, between July 2024 is you can see that the data immediately shrank back down. They were looking at that as being kind of, you know, anomalous, and that it was immediately rectified and the conditions weren't there to satisfy it having been triggered. Whereas we're seeing missing data and inaccurate data there on the chart for the recent past, and there's a different reason why they're not talking about this one, because if we did have the data there together, we would see that it not only did it trigger, but it didn't immediately reverse. It didn't immediately reverse yet, and in fact, unless unemployment data comes in below, you know, a whole percentage point lower almost in one of the next 3 reports, then you're looking at the average still forcing that to be officially triggered, you know, over a period of time, saying we have to acknowledge that this is the case. So something has to change here, because we've only got 2 data points to work off of. You know, 1 data point to work off right now, which is the latest result, which is 4.7. So it's not until January or February that we get to have the next official 3 consecutive months to be able to add up an average and say that's now beating the previous one, especially because this delay, what it's done is it's moved us into a period where the unemployment regime really changed. So it's defeating the purpose, the built-in purpose of this, because it's supposed to be a real-time upfront indicator of recessions that's super accurate, and it's being applied with this delay, which means that the comparisons of data versus earlier periods are being compared versus worse data periods. So when you're talking about the SAM rule being a change, about a delta of a 0.5 change, what you're saying is that businesses, for that to happen in America, businesses need to be actually actively losing their employees, dropping them, sacking them. There's actual layoffs happening. There's stuff happening there. You know, it's real. It's indicating of something serious, but it's being ignored because of this layout of the data. And this loss of data in October kicks the can down the road so much more that even when it is being compared, it's being compared against worse data. So the change, the differential is happening, but then that's not being represented in the economy, in the big high, and when we look at the highs, it's like we're up here at highs. You know, what's going on? Why are we up here? Why is the all-time highs on this happened in around October of 2025 and we're at December now, if the economy has been so bad to get us into a point where that there has been triggered and would have sustained had it not been for a lack of data by the government shutdown? Almost couldn't have been planned better to be able to ignore that. So why is that incredibly serious thing, which has got like this Wikipedia page dedicated to it, which shows you all of these incredible outcomes that happened with it in the past, and it sits here and it has this dot on it for 2024 with no real explanation, and next time it's going to have what, a series of dots? This is just going to rewrite the article to say it worked until and then it broke. And that's where we find ourselves able to identify the problem, because what has really changed since all of this? And this is where we get into answering and understanding the macro fully right now, and what's going on with the Fed, interest rates, everything that's coming up, and to be able to understand, you know, basically what's happening. Problem is inflation. You've got old inflation, right, which is existent, the current inflation that's trying to fight against what they talk about all the time, and then that's what the Fed's trying to battle. But also in a meta sort of, in an indirect way, it's trying to battle a return to inflationary environment. It can't risk a double recession event. It doesn't want to return to inflationary environment, so it has to fight against that as well. So the result being that it cannot talk about cuts. It can't say, oh, we're going to make cuts. Why? Because that encourages people to start spending now, and that encourages a return to inflation, and it screws over their future case. So that actual guidance is very much inflationary, so I can't really say that out loud. But the SAM rule is effectively silently triggered in the background, and they're very much aware of what I'm talking about. Perhaps the only other 12 people who've ever discussed this outside of this particular audience and myself. However, too late in 2021 was a public admission that the Fed made after the inflation began. Why? Because they were looking at employment and not looking at inflation, and the inflation figure started rising. It caused this really long-term problem, and they admitted publicly, Jerome Powell and stuff said, oh, we acted too late, which unfortunately gave him a nickname where it became Too Late Powell, which means that there's this actual reputation, and that itself creates fear in the markets. That's the situation at the Fed right now, and it's real, it's material, it's significant, and it's very much front and center of the main problems, not just some heuristic or symptom of some other underlying problem. It's actually part of the disease. Looking at here as well, on the other side of that, you've got Mr. Taco, right, who earned himself his own nickname because of his tariff regime, which had off and on again startness, created so much mud in the water, and there were a lot of real tariffs, and they still are, so it's so inflationary as well. There's trade wars, there's real wars, there's actual stuff happening in the world, getting stuck into all of it in a very chaotic way, and this is creating real-time threats to the economy. And these two things are actually looming very, very, very much at large, and they're kind of juxtaposed against each other, because of course it's sort of the off and on again tariff confusion monster versus Mr. Too Late, who obviously can't act whenever the other's acting in such a way. Now, it's funny enough as well, if we do look back to when the last time the SAM trigger happened, it was during Trump's presidency. Jerome Powell was, of course, the Fed of the chair. So in the entire history of the US economy, this has only ever been triggered twice, if you can include now being triggered, and that's been both presidents, the same president. We've only ever been triggered twice by one president. What's that? So I'm trying to say it's only ever happened once that one president has triggered this thing twice, and it's only ever happened once that one Fed chair has triggered this thing twice, and they're both kind of quite slating each other in the public. So we know that there's a conflict there, and we know that this is historical, meaningful, really up and important, headline stuff. And the other thing about this as well is that the truth then can't really be talked about, while the struggle is for credibility on either side. This becomes a policy trap, right? And it's not a policy error or a policy mistake. And you could look back at the first time around where it was too late and say that was a policy mistake. And then you could look at Taco and say these off again, on again was very much lots of mistakes, and say that was the policy, it was an error. But actually for both gentlemen this year, it's been policy trap after policy trap, and that's the problem. And the current economy, and this is why there's so much indecision, in the markets, and this is what's going on here, right? Overall, the Fed isn't wrong and the Fed isn't right. It's neither of those things are the reason. It's not that cuts are coming, and it's not that recession is guaranteed. Neither of those things are like the story. None of those things, none of those four things are the story. It's not about that. It's not about mistakes. That's not what's happening now. This is about the credibility being constrained. It's a different thing. It's all about credibility being constrained by these major actors, and they can't act using their credibility to offset any of this stuff, because that's not part of the story. The only solution to this, you could say, and I've got an extra bonus page of conclusion at the bottom. That's a spoiler. This is the first conclusion, right? So you're supposed to completely buy into this one. First off, is that the only solution is that clear disinflation or clear recession, right? These are the two things that will break it. Right now, with the markets dumping, today's kind of story could be seen as being reactionary. People planning on, return to a sort of recession, and this is early signals coming from Bank of Japan and the US jobs report signaling weakness in the economy when the Fed is unwilling to move, so on. That could be the story that dominates following this. But this sharp move down here is somewhat structural as well, and if we look back at the technical analysis from the past, and we can see where prices have come down to test, maybe this chart isn't the best for it. There was a gap here on some things that was filled. This is a test of liquidity in this area. There is a structural element to this move that's happened, which has taken us down to this zone we've already marked out as being important. And it's, you know, there's an aspect to this where there was a push up today which took it back towards resistance. It then failed and the markets then plummeted down with momentum and structural stuff happening. In crypto, the move up today wiped out $120 million in short side, and then the vacuum that created, along with everything else, has then propelled us back down the way, getting all the longs that went in there liquidating the way down and momentum towards the downside. There's something more or less kind of reactive and about testing market structure here, more so than an actual expression of confirmation of one story or the other, because that's still happening this week, as well as the fact that there's the digestion of the news so far. So I can't say that that's being sort of just fully like signaling, for instance, like, oh, okay, the Fed tried cutting in December, but you know, it's clearly the recession narrative is won out. Absolutely not. There's not that. And then, of course, there's the clear disinflation narrative. And the has there been that yet? Not yet. Well, that's why I brought up CPI coming out on Friday in America at the same time as the Bank of Japan raising its rates, or the same sort of day, not the same time because they're different time zones. But and which narrative will win out this week being super important. But also, this is the macro story too. You know, it's more than just this week. And why clear disinflation is like worth mentioning as a possibility as being something that changes the sentiment in the markets, and then on reflection changes this into just purely technical, mechanical movements in price as they're seeking liquidity and testing in a volatility, using that to just take the momentum trade on the day, regardless of like what the underlying truly is in terms of their directionality overall. This is a point worth remembering people about, because we opened up on these headline events, one of them being that UK Consumer Price Index came in with a material surprise in November, 3.2, which is down from 3.6, and people are looking at the US numbers and hoping for a bit of a surprise there because of the fact that, of course, we've had this period of extremely sustained unemployment in the US, which has not been acknowledged by anybody, at risk of sounding like you're going to have to make cuts, which would be a return to an inflationary environment, so must not be mentioned, despite the fact that you've got credibility and reputational damage, and you're up against somebody who's also using the fact that they have no credibility to be able to continually apply the weave type inconsistent policy chaos in order to have a practical end goal. So it becomes a policy trap for both sides, not a policy error, and that is credibility being constrained. And the question then is like, what's going to break it? The answer is clear disinflation or clear recession. But I want to also put in a conclusion here that's kind of actually takes a synthesis and satisfied takeaway for y'all one step further, because the Russell and Alts bear for 4 years is quite clear. And there's also been this happen in the cost of living crisis, yet pension and index traders, sort of funds, all that, are not been have not been at much risk. But this is why also inflation has persisted, right? That inflation has persisted during a period while this has been going on, and that the national debt continues to spiral, right? So if you understand these things, and this is what takes me back to my point earlier on about ecosystem, right? Then what you understand is that all of this adds up to, what's it all add up to? It's easier to see us now in a 2000 or a 2006 period than is to have seen us as having lived 4 years of economic pain. Nobody's willing to admit that to themselves, but I've been talking on this channel for a long time about the cost of living crisis. You've all experienced it in your own lives, and you've seen it in the middle belly of stocks, and that anything that you invested in that had any sort of was supposed to have any sort of beta on it and perform better hasn't been able to do so, and hasn't had any return to 2019 type environment, and hasn't had any of the positive economic impact of the economy since COVID, and then also has been very much exposed to the quantitative tightening which continues, and the interest rate environment, even though Europe's got 2%, and the market panics when Japan raises its interest rate to 0.75, which is basically still nothing. It's still basically free money. And as well, they forget that up until 2015 there was same or smaller spreads between Japan and USA. So actually it's nothing like the USD JPY dynamic. USD JPY has of course gone up, as you can see here, but it's nothing like the USD JPY dynamic, as you can see from the past. So just go to a big time frame though. It's not like the in terms of like, look if we go back all the way to the 1980s, 1990, and then look to where it is now, the JPY is priced higher than it has been at any time in the past 30 years. Okay, that's that same thing happening again. You're seeing it on the USDY charts. You know, this sort of technical analysis shows you all the information that exists at any given time is quite clear in this example. But that isn't because the last four years has been a rush towards JPY because we've been in a recession and pretending it's a bull market has it, because technically, because the textbooks tell you that this rise in value of JPY of 55% over the last 4 years, since we're supposedly been in a 4-year bull market, has actually been a textbook signal that there's been not a bull market in the USA. It's textbook signal. So what's going on here? Why is there that conflict of information? Incredible, right? So wow, my God, what you're learning about here is that you've been living through 4 years of economic pain, but all of the signals that would allow them to publicly talk about that and act on that information to alleviate the situation have not been happening, been impossible to happen because of the situation I explained in the previous conclusion 1.0, but here we are in conclusion 2.0, and you're able to synthesize and take away real data from that. So when you look at this 4 years, it's not been Biden or Trump. It's incredible. You think 4 years, you hear 4 years, you think president. Well, it's not that. It's not Biden or Trump. It's both of them. What you've had in the last 4 years has been, of course, the long-term conditions that led into it, the long-term conditions created by another, and the long-term conditions being created now, all at odds with each other. You've got conflicting policies and methods. You've got conflicting international approach, foreign policy, etc. Every time, though, what's been going on, and you can think your mind back to the last several years, whether it's a check you got through the post with Donald Trump's name on it, or a reaction during high interest rates to economic financing happening in China for electric vehicles, where Biden imposed tariffs and then made the new economic deal with America or whatever, to try and fight inflation supposedly by giving them money. What was that all about? Well, that was all about front loading, the government front loading fiscal policy, right? So and that means that the Fed is not being tasked with responsibility. The independence of the Fed is challenged by the front loading of the fiscal policy by the government, and has been for more than 4 years, but it's created a 4-year sideways movement in everything that actually matters. But the things that have got such importance on a smaller scale overshadow that and actually make the indexes look good. So what you have here is the government front-loaded fiscal policy. Therefore, Jerome Powell continues to seek credibility. Jerome Powell has to continue to seek credibility during this. That's what's going on. So the real conclusion equals one of these conflicts needs to resolve prior to from on the prior, like more than just on the prior page. One of these conflicts needs to resolve. It's either inflation versus recession, or it's government versus Fed, right? So it's not just inflation versus recession as the dynamic as the previous one said. It's this or this needs to change. Also, what could happen is the government or the Fed needing to change their stances, and the optionality built in by not talking about the sand rule and all of this, what feels like a scam, is actually the optionality that gives them to be reactive under conditions where they're otherwise what we've already outlined as being how did I phrase it exactly, as credibility constrained. And that means it's not a mistake cycle, but it's a credibility constrained cycle, which is creating indecision in markets and allowing the price discovery to happen in jolts and bolts like we're seeing today across all assets. Time is 5 to 8 right now. We don't have much time left in the show. Did we make it to the goal? We did. I'll do a bit of LivePerson technical analysis on the assumption that that's what people were asking for. I'll just double check the ones that came in. Yep, nobody asked for anything else. Okay, so last week we did got a good work. Makes this a little bit easier for us today because I did indeed cover what needed to be known. As you'll see in just a second, we spoke about the markets possibly coming back down into test challenge in this area. It did get a bounce off of it. Looked like it was going to perhaps manage to do okay because it was up there filling in a gap and pushed a little bit higher, left a gap to do that gap fill as it happened, which then it filled again, pushed down the way, and it went back in to test off these lows. This is a response to like everything else in the market today. It's been hit exactly the same way, exactly the same. It's because nothing's trading off of the thing. It's all just the testing off of liquidity areas, because markets are seeking liquidity during a time of extreme confusion. It would have done it in either direction, but the low side won out after it responded. You know, it became a bit of a bull trap today based off that short knowledge, because the fear still is so high right now in markets because of the upcoming carry trade risk, etc., associated with the 19th of December. Come back down to retest these lows. That's no big deal. I said I wouldn't be minding too much about it so long as it didn't break below this, you know, the low of this box essentially. But going back into this box is obviously crap. And that's where we stand on this one just now. How do I feel? I feel that this is actually the lowest risk buy that there's been on this stock in its lifetime, really overall, since a company here which is actually, you know, looking at being able to deal with clients needs this resolution to happen in its favor, whereby because of the fact that there is of course a silent SAM trigger, and because the Fed can't talk about it, but we do have some people from the Fed today talking about how they would be making different policy decisions. What we can then see is that perhaps the pressure does build in order to deal with this, but we have to, you know, make it through this credibility cycle, and then we get looser financial conditions. This is the thing that's going to improve the life of this company most possibly in the next short-term period. But when Nvidia is dumping as hard as it has been today, then it's no surprise that that could be a problem currently and persist. So for markets generally speaking, so this one's been exposed to that as much as anything, but I don't feel like this is particularly bad. It's a buying opportunity in my mind. Of course, there is the risk that this thing drops down towards the lows of this box. Do I feel like the you know, in some ways me doing technical analysis on this one is like a risk in and of itself, because the float is so low, and I'm talking about potential price targets, and the market is in a period of high uncertainty, needing to have grounded information about where it could go to. And really realistically, like this upward movement so far, following the massive reaction to the fundamental changes that have happened in the company, right through to the latest earnings report and so on, have actually not been pushing lower than the low. So we're looking for this to really bottom out. And as I said last week, the movement we've seen since did on the Thursday take us up towards highs of 550, back down to lows of 450. So this is volatile AF in this section overall, looking to try and form out hopefully what becomes like a classical sort of double bottom in this area overall here. Does there remain any fundamental increased risk to this company that have been changing recently? No, not necessarily. We are looking for increased clarity on them over the next wee while, and running into this period towards the end of the year for a Santa Claus rally to take us towards highs, I think would be difficult before resolution of the Bank of Japan and the inflation data coming out just, you know, in the next wee while. So this has got a lot of headwinds on it in order to be super impressive, but the range of its easy move volatility is so high that I think a sudden bounce back up here should be of something that people are alerted to. Although this is not financial advice and I'm not a financial advisor, I would be looking towards targeting that round number of $5 before you even think about where would be a good value short. For the institutions who are watching this, hello institutions who want to trade against this amazing trading community, that would be unwise, but it'd also be incredibly foolish as well, because by that point I think we should have greater resolution going into 2026. And the case that this boils down to overall is, how are you going to spend the next 2026, 2027? And the guy who was talking, from the governor from the Fed, who was talking today, who was saying that we have to be forward looking for 2027, was not wrong, and is actually about forward planning as much as about backwards planning at this point for the economy. It really is. He's not wrong, and we're yet to see that resolve, and that should be getting much greater clarity into the new year as this uncertainty is resolved. Right, that's the situation. This has been one of uncertainty, and I think that the last few candles on this showing us that it's not got momentum into the downs is absolutely showing us that there's a bullish divergence, which means that this here, provided it doesn't move any lower, makes this a hidden bullish divergence dynamic, which does give the opportunity for prices to come into the higher range. So it'd be very foolish to short this until it had at least broken that low from the point of view of the nefarious shorter. But of course, like I said last week, the magnitude of moves towards the downside had become such that the risk here is far too great for any bear. It just is. While prices could move down, I don't anticipate that happening, just purely because the risk for bears is just so great at this point, and it doesn't make any sense from a rational point of view. But I have explained the rationality behind markets right now, but this complicated story is so complicated to people, they don't understand the rationality behind markets. So just to give you a sort of conclusion on this here, chat, because it's been very good, but you might not really understand what the conclusion is. Just want to reiterate it for you again. Small caps and alternative assets have effectively been in a bear market for 4 years. At the same time, the cost of living pressures have persisted, inflation never fully went away, and government debt quietly absorbed the shock. Because pensions, index trackers, and headline employment weren't at existential risk, it's easier to frame this period as a bubble, like to think it's easier that we're in 2006 or the year 2000 than it is to think that we are actually experiencing that pain right now. You can't really admit to yourself emotionally that we've already lived through a long and uneven adjustment whenever you're looking at such clear pain signals of what's to come in a typical fashion. The reason for all of this is because, of course, what we've discussed has been the dynamic that's existed since the COVID changes, and this last flash of the SAM rule has never fully been worked out of the economy as yet. One of the major distinctions between all these is that it spent hardly any time below this figure. In fact, since 2020, it's been weak markets the entire time, and that has been underlying weakness in the economy, which has been hidden in the fact of equity rises up. The equities have risen up. Why? Because of inflation in terms of monetary supply, as much as anything else, and that as well. So we've got here, and because of their metrics are improving because of inflation. So what we have here is a situation where something's been hidden, and that's why it's easier to think that we're about to experience the crash rather than this has been the entire pain since the crash. Whereas in the past, it's like gone down over a period of time. This one, due to the mistakes that happened in the past already, the too late mistakes, etc., it's taken 4 years to fully work its way out the system. Or else, if it doesn't, then the Fed are running the risk of creating a new crash where they didn't have otherwise had to, but their hands are tied, because they can't act unless employment forces them to act and inflation remains high, which it does because of all the dynamics we've explained so far. So this isn't about one presidency or one policy mistake. It spans administrations, it conflicts fiscal approaches and repeated front-loading of government action. The result is a Fed that now prioritizes credibility over comfort. It's willing to let the middle classes and the middle belly of the economy all suffer in order to keep credibility, because if you lose credibility, you've lost everything, and that's when you get the worst recession with inflation. So that's the final line that cannot be crossed, and that's why they're defending that with all their life. So the real conclusion is simple: if neither inflation nor recession breaks first, something else in this ecosystem eventually does. And this isn't a single point of failure, it's an economic system. And that's what you have to understand, is what you've learned today is an ecosystem. That's what you've been learning about, an ecosystem. And by teaching you an ecosystem, I have sneaked in the most incredible economics lesson that you have ever had. This explains to you why there has been inflation. If you look back, you can see that the inflation has persisted because of these dynamics. And this explains why the decisions are being made the way they're being made, and explains why they're speaking about them. It's the single unifying theory, and it's also based off of hard data and not speculative stuff. And not only is it off of the hard data, it's off of extremely important data, which has got a very anomalous interruption in its reporting that's never happened in its history before, and it's very revealing about the way that this system works. Not to be conspiratorial about it, just to say this is very revealing information, which I've then synthesized into actual takeaways for you in today's show. I hope that's been helpful, and I really do appreciate everybody tuning in today for what we do. Bitcoin is actually one of the biggest things that I think people are probably looking at right now in markets. And I think just to leave you with a visual in terms of understanding, this is the way the markets reacted and then came back down afterwards. The reaction towards the top side was an appreciation of risk on appetite. And then the drop down afterwards was the realization that that won't come until we've experienced a risk off hurdle in the meantime. And that volatility, it goes to show you about how, you know, this risk on asset front loads everything for you visibly. Worth pointing out at the end of the show. I'm Rocky Outcrop. Hit that like button, be a part of what we do. Thanks very much for tuning in today. If this is your first time, because we like to see new faces around here, and make sure you get over to my website www.technicalanalysis.school so that you can understand technical analysis in a way, oh my goodness, it's the best. It's the best. You should take advantage of that discount. Save 500 today. See you all next time and join the Discord.